What you must know from the stock market crash of 2024. The market's downfall. Should you really sell everything? Hey everyone, I've been seeing a lot of panic online lately. People saying they're ready to ditch the market altogether, sell everything, and brace for the worst. The truth is, I get where you're coming from. The market's taken a beating lately. Stocks, crypto, you name it. If you've recently started investing, it's easy to feel overwhelmed by all the red on your screen. That's why today, I want to tackle these concerns head-on, explain what's driving the market mayhem, and share some strategies on how you can navigate these turbulent times. Before we dive in, I want to be upfront. This video might not have the usual bells and whistles, but that's because I'm prioritizing getting this info out to you fast. If you've been anxious about your investments, this is definitely a video you shouldn't miss. What's causing the stock market to dive? Let's start with the hard numbers. The S&P 500 just saw its biggest one-day drop in almost 2 years, falling by 3%. The Dow wasn't far behind, slipping by 2.6%, and the Nasdaq took a 3.4% hit. If you're watching your portfolio, this probably feels like a full-blown crisis. But is it? Let's break down what's happening. Reason #1. Recession fears. The word recession alone can send shivers down any investor's spine. It's no secret that if the economy dips into a recession, the stock market usually suffers. Historically, when less money circulates, companies earn less, leading to job cuts and even less spending. It's a vicious cycle. But here's where it gets interesting. Despite the fear, we're not technically in a recession yet. The market, however, is reacting as if we're on the brink of one. So, why is everyone so jumpy? Recent reports showed that the US added only 114,000 jobs in July, below the expected 150,000. Unemployment also ticked up to 4.3%, the highest since October 2021. Now, these aren't catastrophic numbers, but they've triggered something called the SARM rule. This rule, which has accurately predicted every US recession since World War II, activates when the average unemployment rate over 3 months rises by 0.5% from its lowest point in the past year. Even though Goldman Sachs has raised the odds of a recession in the next year from 15% to 25%, the creator of the SARM rule, Claudia Sahm, doesn't believe it'll be right this time. There's also a growing sentiment that this might be a false alarm. Unemployment isn't rising because people are losing jobs, but because more people are re-entering the workforce. But here's the kicker: recession fears are only one piece of the puzzle. The real question is, how is all this affecting your investments? We'll get to that shortly, but first, let's talk about something equally important: interest rates. Reason #2. Interest rates. Interest rates have been a hot topic lately, especially after the Federal Reserve hinted at cutting rates soon. Historically, every time the Fed has cut rates from a peak, a recession followed not too long after. And guess what? The Fed just gave us that signal, but this time it's different. To understand why, we need to look back at why the Fed raised rates in the first place. When the pandemic hit, inflation skyrocketed, and the Fed had to raise rates to keep it in check. Now that inflation is finally cooling off, the Fed is considering cutting rates again, not to stave off a recession, but because they're close to hitting their inflation target. Lowering interest rates usually gives the economy a boost because it makes borrowing cheaper, meaning more money flows around. So, while the Fed's past rate cuts were often about preventing a recession, this time, it's more about fine-tuning the economy. That's why this could actually be a good thing for investors in the long run. Reason #3. Tech stocks are taking a hit. Now, if you've got tech stocks in your portfolio, or if you're invested in the S&P 500, you've probably felt the pain of this recent downturn. The Magnificent Seven, Apple, Amazon, Alphabet, Meta, Microsoft, Tesla, and Nvidia, have been leading the charge in the market, making up around 31% of the S&P 500. When they drop, the whole index feels it. The problem? Tech stocks have been riding high on the AI wave. Last year, everyone was talking about how AI was going to change the world, and stock prices soared as a result. But now, reality is setting in. Companies like Apple and Nvidia have recently faced setbacks. Apple's AI unveiling fell flat, and Nvidia's new chips have been delayed. Even Warren Buffett's Berkshire Hathaway has cut its stake in Apple by almost 50%. The hype around AI might have pushed these stocks to unsustainable levels, and now we're seeing a correction. If you've been through the dot-com bubble, this probably feels a bit familiar. Stocks that rise too fast tend to fall the hardest. But just because tech is struggling now doesn't mean it's time to panic. Remember, the market is cyclical, and what goes down will eventually come back up. Reason #4. The Japanese yen and global markets. Finally, let's talk about something that might seem a bit out of left field, the Japanese yen. You might be wondering what Japan's currency has to do with the US stock market, but there's an interesting connection here. For years, traders have been borrowing money in Japanese yen because of its low interest rates and investing it elsewhere. But recently, the Bank of Japan raised its main interest rate from nearly zero, causing the yen's value to increase. Traders who were using this yen carry trade strategy suddenly found themselves in a bind. They had to sell off their assets to cover their losses. This unexpected move has added another layer of uncertainty to the global markets, contributing to the recent sell-off. While the Bank of Japan has since eased up on raising rates, the ripple effects of their initial decision are still being felt worldwide. Navigating the market storm, my strategy. So, now that we've dissected what's driving the market downturn, let's talk about how you can protect and potentially grow your investments during these uncertain times. First, remember this key phrase, buy when there's blood in the water. It's a bit graphic, but the idea is simple. When the market is down and everyone else is panicking, that's often the best time to buy. Prices are lower, which means there's potential for greater gains when the market rebounds. Of course, this strategy only works if you're in it for the long haul and have an emergency fund to fall back on. The last thing you want is to be forced to sell at a loss because you need the cash. If you're new to investing and have been waiting for the right time to start, this might be it. Dollar cost averaging, investing a set amount at regular intervals, can help smooth out the bumps and ensure you're buying in at a lower average price. Second, diversification is your friend. Spread your investments across different asset classes, stocks, bonds, even crypto, so that if one sector takes a hit, you've got others to cushion the blow. If you're invested in an index fund like the S&P 500, you're already pretty diversified, but consider adding a total US stock market fund to your portfolio for even more coverage. Third, keep your eye on the long-term prize. When the market dips, it's easy to get spooked and consider selling everything. But remember, market timing is incredibly difficult, and selling when things are down locks in your losses. If you had sold during the COVID crash in 2020, you would have missed out on the massive rebound that followed just a few months later. The US economy, despite all the doom and gloom, is still strong. Market corrections, where prices drop by 10% or more, happen roughly every 1.5 to 2 years, so this isn't out of the ordinary. Think of it as the market taking a breather after a long run-up. Final thoughts. Staying calm in a crazy market. To wrap it up, yes, the market is volatile right now, and there are a lot of factors at play. But with the right strategy, you can not only protect your investments but also set yourself up for future gains. Stay informed, stay diversified, and most importantly, stay calm. If you want to dive deeper into how I pick my stocks, I've got another video lined up for you. But before you click away, make sure to hit that subscribe button so you don't miss out on any future updates. I'll see you in the next video.